Hi all, thanks so much for joining the broadcast today. We are going to begin in about 1 more minute while we wait for a few more people to trickle in. All right, hello everyone. Welcome. Thank you so much for joining our Morgan Franklin Virtual CPE event, Cash Management 101. My name is Dorothy Hinders and I will be your moderator for today. Briefly, here is our agenda that we will be going over today. Before we get started, we're going to go over a few housekeeping items specific to the On24 platform. If you face any technical issues during the broadcast or are unable to submit your polling questions or have any questions or feedback for our presenters, please submit all inquiries via the Q&A box available on the screen. Our team will follow up with you as soon as possible with a response. Attendees of today's live broadcast will be eligible to receive 1 CPE credit in the field of finance. The Cpe Certification Requirements box is going to be located on the bottom right of your screen and will monitor your progress. You're going to see a blue icon display next to each requirement when completed. To earn your CPE credit, you must attend the broadcast for at least 50 minutes. Don't worry if you get kicked out or accidentally close your browser. The timer will not reset and your completed time will be recorded. You must also answer 3 polling questions via the On24 console. Polls will only remain open for about a minute, so don't miss your chance to provide a response. We will have 4 questions. You only have to answer 3 of them. Let us know in the Q&A box if you run into any issues, and our team will help you troubleshoot. Once the requirements have been met, you will be able to download your CPE certificate directly in the Cpe Certification Requirements box. Please note, sometimes there's a delay in displaying the blue icons, and for some users, the icons may only appear once 3 requirements have been met. If you are unable to download your certificate for any reason, our team will email your CPE certificate within 3 business days. Again, if you face any technical issues or if you have questions throughout the webinar for our presenters, please let us know by using the Q&A box. All right, before I hand it over to our presenter, Corey, I want to quickly introduce to the audience the organization hosting today's virtual CPE event, Morgan Franklin Consulting. That is who is hosting, and we assist organizations with complex transformational challenges. Our differentiator is in how we deliver. Our teams are staffed with a powerful mix of business consultants, industry talent, and IT experts that deploy their skills across our service pillars. All right, now I'd like to kick things off by introducing our presenter, Corey Brass. Corey is a Senior Manager of Treasury Solutions here at Morgan Franklin Consulting. He has over 10 years of Treasury experience from strategic planning, design, and implementation of large-scale change initiatives and system projects in the finance and Treasury spaces. All right, I'll now hand it over to Corey. Take it away.
Thanks, Dorothy. Well, thanks everyone for joining today. We'll just get started really discussing the meaning of cash management, best practices and strategies. So our first slide, we're going to start with the meaning of cash, and really with the business definition of cash is really the exchange of goods, currency or coins for the exchange of goods, debts, and services. It's pretty straightforward in the sense of that we all have it and we all need it. Obviously, our companies need to run their day-to-day operations and allow them to buy goods and services or perform services. The second piece of cash is marketable securities, which we'll cover a little bit later in a couple later different slides. Whether your company is large or small, cash is vital to your operation. So let's talk about how we manage that cash and what the approach is. So with the management of cash, managing cash has a lot of different meanings in the sense of, but fundamentally boils down to availability and the significance to your organization. So there's really two main points that I want to cover. First, it's the responsibility of your cash team to provide adequate cash for your company to operate, and is also ensure that the funds are not blocked when needed. So what do I mean by that? Is that your cash team must first determine the optimum amount of cash required to run the business. And what is that optimum amount? Well, the cash team must keep a balance at an optimum level that allows you to invest any surplus cash in a profitable manner while still being able to pay all of your bills and meet your needs. The cash team must be able to establish prompt collection and an efficient disbursement of cash in order to maintain that optimum balance. And then the second point, cash is really only 3% of your total current assets, and this proper management is vital to staying in business or essentially keeping the lights on. So what do we understand about cash? Although it represents a small percentage of current assets, cash is the most liquid asset. Cash is the common denominator to which all current assets can be reduced because of receivables and inventories. They can be converted into cash, and then cash is needed to acquire supplies, resources, equipment, and generate products and services. It sounds pretty straightforward, but over my 10 years, I've found that many organizations have difficulty managing their daily cash efficiently. Not in the sense that they're not managing or you may not be managing your cash, but efficiently done. There might be outdated processes or outdated applications you're currently using, and you're really trying to dial it in to reach that optimum level. And so with some of the large and small clients' treasury process improvement or cash management improvement, you see the team struggle with the disconnects, business processes within the application. There's never a one-size-fits-all approach, but more of a guideline of creating a foundation towards an efficient cash management system is typically how I work with the clients and how we get started. And so what do I mean by a cash management system? Well, let me explain in a little bit more detail. There's two fundamental pieces to a cash management system. Cash management system is a mechanism that provides the linkage between your cash flows, and you also will need policies to govern those linkages. So those linkages could be through applications, they could be through people, they could be through business processes, and so on. So what the objective is to try to find those linkages and to find some of those disconnects within those linkages to improve your overall cash management system, to improve your cash management efficiency. Because the cash team is responsible, the financial manager is responsible for developing and maintaining policies and procedures is necessary to achieve the efficient cash flow for the firm's operations. So in summary, is that in order to have one, you need the other to depend on, and you could have all the best of state-of-the-art, best-of-breed applications, but if your processes and policies are incomplete or have disconnects, there will be a lot of pain points throughout your daily management of cash. So next, let's talk about what are the tasks of managing those cash activities. So what are some of the daily cash management tasks? So I have a list out here. You have cash collection, so concentrating your accounts daily. You have your collection system, say lock boxes, drop boxes, or mail. Disbursements, funding your accounts to be able to pay your bills. Payments, requesting and approving payments. typically done daily, investing in marketable securities overnight or throughout maybe a short-term period, and then daily cash positioning. Running your daily cash position along with your cash forecast is to allow you to determine what future cash that you'll have on hand. And so now that we understand the meaning of cash and the actions that are needed to manage it, we'll take a look at the 4 motives for actually holding the cash within your accounts. So in business, there are really 4 motives for holding cash. As you see on the slide: transaction motive, precautionary motive, speculative, and compensating. From a transaction perspective, it's really just you're holding cash to purchase raw materials and pay for operating expenses. From a precautionary approach, you're trying to meet future contingencies such as pandemic, flood, strikes, failure of essential customers, bills that may be presented for settlement earlier than expected, unexpected slowdown in collection of account receivables, or maybe cancellation of some orders or goods that a customer is not satisfied with, or services, or possibly sharp increase in cost of raw materials. Next is the speculative approach, was taking advantage of the market, which is opportunity to purchase raw materials at a reduced price, interest rate movements, buying securities when interest rates are expected to decline, delay in purchases of raw materials on anticipation of declining prices, or purchases at favorable market prices. Last is compensating, and compensating is the most common, maintaining a cash balance or threshold to offset the bank fees, services, or loans. And typically this is pretty straightforward and happens most often. If you take out a loan, there's going to be a compensating balance that's required, or in order to maintain your lower fees or reduction or removal of fees, you're also going to create a compensating balance as well. So they're very common with most of the financial institutions all over the world. Some of the, say, APAC or EMEA, you'll have different strategies, but nonetheless, pretty standardized across the board. So how do we control that level of cash, or how do we control the balances, optimum balances? The level of cash can be reserved or should be that only that which is required. What do I mean by that? To control your level of cash is that you're going to need a cash budget. Your cash budget is going to be done by estimating your cash receipts from various sources and cash payments from the different payees, which is very important to think about from the various sources, because those are therein lies the issues of getting the data into your application or getting the data to a certain team in order to calculate and estimate for your cash receipts or your payments, your outgoing payments. From a cash budget is an estimation of cash flows for a business for a specific period of time. Hence why you're running your cash position daily to see exactly what your exposure is at. The budget is used to then assess whether the entity has sufficient cash to operate. That's using your forecast. Then from your forecast, you have a cash roll forward. That's going to compute the cash inflows and outflows for the month. It's also going to use the ending balance as the beginning balance for the following month. So typically when I'm setting up, in an application looking at a cash position worksheet, these are some of the fundamental things that we're looking at from a bank account statement level in order to kick that cash position off. And this process is going to then allow the forecast or your forecast needs to throughout the year, and the roll forward piece is going to adjust the balances based on the fluctuations of for future months or market volatility or changes within the organization, as I talked about previously. So in other words, to manage your cash properly, you're going to need cash budgeting guidelines combined with, I say, best of breed applications, along with best practices cash management policies. So those three things together are going to build those foundations and start to reduce some of the pain points within your daily cash management processes. So what are pieces, or I guess from perspective, what are parts of the controlling your level of cash from an internal and external perspective? When it comes to controlling your cash balance, these controls are critical. To use external controls, you're going to need to implement your internal controls. And typically already established, you have your external controls because you're probably already using bank accounts, collection systems, disbursement systems, but you may not have everything from an internal perspective. So starting from that, you're looking at utilizing a TMS system, ERP, or both. That, in a sense, is going to ensure that your financial data is accurate, which is obviously important for reporting, that there is efficient processes implemented, and that you have standardized policy processes in place. Next is reconciliation process. Controlling the balance and understanding what you still have left outstanding. The reconciliation process is where that comes into effect because it ties into your cash accounting, a process where the cash accounts on the business books are regularly checked against the bank statements. So you can have system to bank transaction activity, and then you can have book to bank where you're month end and you are doing a reconciliation of all of your cash accounts. The next is a voucher system. You're going to need a system focused on documenting every transaction aspect to ensure that all required payments are made and that they were only made once, which is very important from the sense of not only control of your outgoing payments, but also from a perspective of what's been paid on the reconciliation process. Next, in order to move or pay your bills, you're going to need an ETF or electronic funds transfer setup. By using these services, you're going to be able to transfer funds automatically through the application, through, say, a treasury management system or an ERP. A business can minimize the number of people that have the access to funds, but also improve the availability to be able to send funds whenever needed. These types of transfers also generate documentation that show when transactions are made and who is the requester. So what's important about it is that you have the policy and guidelines of your EFT process and sending payments, which allows you then for a better hit rate on your reconciliation. Last is cash accounting. As a result, and I like to look at this as the result of your payments and bank statements flowing into your application. You have the opportunity to record your accounting. Payment receipts during the day, which when they are received, and expenses are recorded when paid. This is going to give you the next level up on your data accuracy and availability to do your daily reporting for the next day for doing your positioning and forecasting. Sorry, my cat's meowing. So next, we want to talk about the capabilities of cash management systems. So what I outlined is a very poor cash management. It's pretty straightforward. A lot of you probably already are doing it, but you probably may have pain points in the sense of how you do it daily and what those process steps look like. So controlling the level of cash would typically be two basic processes involved in the payment process. Is the AP department typically does the approval of the payment and making AP payments completed by, and then the initiation of or the sending of the payment is done by your treasury team. From a policy procedure, typically the approval is along these lines is high business value with typically high dollar amount, but not always is treasury approval, and a low value amount but high volume is an AP approval. Sending these payments will comprise of a standard or proprietary bank format for your application, or you may be loading them into your bank portal for the bank application. So when it comes to your payment distribution for those payments, it's best practice to use cash management system as a payment hub. This will provide you with more transparency and data accuracy. It also allows a lot more control, and it allows you for data continuity in the sense of that fact that you have that real-time accounting data immediately from the disbursement of the payment. So next, I'd like to talk about what the cash concentration process looks like and what it entails. The cash concentration process of sending all available cash to a main account or concentration account is pretty common. Cash collection is also known as a payment collection process where a company will recover the cash from other businesses or individuals to whom they previously had an invoice with or owed funds to. And a designated bank account or depository lockbox, a central concentration account, will really perform three main tasks: receive the deposits from banks and the firm's collection systems, transfer funds to the firm's disbursement banks, and then serve as a focal point for short-term credit investments and transactions. Why it's crucial is because it allows you to collect or move excess cash or surplus cash outstanding in your other regions into a main concentration account, which would then allow you to invest it at minimum overnight in a money market account and whatnot. So what are the components of cash concentration to consider? Some of the components of cash concentration are what I break out into three areas. The types, you have your over-the-counter mailed payments, pre-authorized payments, and lockbox systems. Your mechanisms for moving the money, depository transfers, your automated clearinghouse, and your wire transfers. And then frequency of transfers, whether you have it scheduled like a controlled disbursement, a ZBA such as a trigger transfer, or a funding of the account for an anticipated transfer. So now we've covered the collection process. Let's talk a little bit about the disbursement process. So from a disbursement process of three tools listed here: zero balance account, controlled disbursement account, investment in marketable securities. So zero balance account, most common, no cash is kept in the account, single sweep daily, and the amount to cover the expected outstanding payments is sent based on the outstanding amount. From a controlled disbursed amount, it's a little bit different. Cash is kept in the account to cover the possible outstanding bills that are coming into the system. You may have multiple sweeps, typically company-initiated requests where the bank will notify you, and then you're going to then fund your account. Amount is sent to cover the expected outstanding payments. Typically, there can be a threshold or not such a threshold, but excess cash left over because your expected amount that owed wasn't necessarily what you were looking or what you were expecting on your forecast. And then last is investment in marketable securities. Investment in marketable securities could be a common or preferred unrestricted stock from another business, a banker's acceptance note, commercial paper, an exchange-traded fund, or even a U.S. Treasury bill. So from the perspective of, just to kind of recap here, is that from the cash management system, you're going to have a number of channels or facets that you can move your cash around from a collection disbursement perspective. The investment piece of it is very crucial to how the cash is managed to gain additional interest income off of that excess cash whenever possible. Okay, and so next we're at our first poll. I'll hand it over to Dorothy.
All right, this is going to be our first polling question, the first of 4. What is the maturity level of your cash management process? Ad hoc, emerging, standardizing, strategic, none of the above. This is an interactive slide. You can go ahead and click right on your answer. Just keep in mind that you have to answer 3 out of 4, and this is the first of 4. And we'll give everyone another 30 seconds or so to get their answer in. All right, just a few more seconds, and then we will view the results. All right, let's take a look at the results. Corey, what are your thoughts on these results? Is what you were expecting, not expecting? What's your take on this?
Yeah, I think that looks pretty straightforward. We have a few ad hoc and a few emerging. So it looks like, between the standardizing and strategic, they may have already gone through some sort of process improvement project where they're improving their cash position or approving their cash management system processes, installing policies and so on. So, that's really great.
Awesome. Well, that is our first polling question. Corey, I will kick it back over to you.
Thank you, Dorothy. So next, first I want to thank everyone for participating in the poll. Just to recap, we covered the meaning of cash, managing levels of cash, and the components of concentration and disbursement tools. Next section, we're going to talk about cash management objectives. So overall, with the objectives of cash management, I listed out two objectives. Two objectives being that one is to meet the requirement of disbursement needs as per payment schedule. So your wages, your purchases, taxes, bills. The other piece is to have a minimum amount of cash that is locked up in the balance. Fundamentally, both of these objectives mutually contradict themselves. As a result, this is why it's challenging to maintain a balance between the two. And hence why we have so much work around managing cash or balancing our cash efficiently and adequately. So next, talk about preparing the cash balance. From a straightforward perspective, in order to know what your cash balance is, you're going to have three basic steps. First step is your opening balance. Your second is going to be adding cash receipts to deduct the payments that have been made. And then third is preparing the closing balance, which will be your opening balance for the next day period. This should be done daily. You want to use that variance of your daily balance against forecast for the next day. This is going to determine your accuracy of your daily cash position. And it's pretty critical to measure yourself, maybe not daily, but weekly or monthly, as to how well are you doing to predicting your forecast based on your variance to your daily position. And sometimes that can take a number of months or years to really dial in correctly. So controlling the level of cash, in other words, your cash balances, is you're going to have to control from the position and forecast perspective, the level of inflow of cash, your level of outflow of cash. The result of that cash is the surplus, and that surplus cash should be invested overnight or in some other product marketable security product that you find profitable. From the next perspective, or in the next slide, we're going to discuss cash inflows. So the objective of getting cash back into our main collection system to be able to position your daily cash position accurately, the objective of the collection system is going to do a few things: minimize your opportunity costs of any excess balances, minimize the transaction costs, administrative costs, and cash control costs. To set up a best practice collection system, you're going to need to make a few decisions along the way to get to that point, to where your strategic or standardization of your cash management process. So what are some of the decisions or typical collection decisions based on the collection part? Selection concentration banks, sweep structures, level of authority for authorization for your sweeps or payments, policies for determining when to collect, how much to collect, account authorization, who should have access to those accounts, and then balance minimums. What are some of those balance minimums that you need to have or maintain within those accounts to have a loan or some sort of service to offset those costs? So now that we've covered collections, we discuss the objectives of the disbursements. So the objectives of disbursement system: you want to maximize the value of your disbursement floats, minimize loss of discount for early payment, minimum transaction costs, information costs, administrative loss, control costs. You want to maximize the value of pay relations, and you also want to establish a centralized disbursement or centralized disbursement account that allows you to provide those funds efficiently and adequately on time. So So what are some of the disbursement decisions that you would need to make? Selection of disbursement banks, disbursement payments, and account funding mechanisms, your level of authority for disbursement, policies to determine when and how to pay, disbursement authorization, funding amount and time, and payment preparation for release. And so if you look at from the perspective of your daily, depending on how you do your daily sweeps or your daily sweep structure, some of those are going to inherently come with restrictions as to when to send or how much to send. So now that we've covered disbursements in concentration, I'd like to talk a little bit more about cash management strategies. But first, we have our next poll.
All right, this is going to be the second polling question of 4. Which area do you have the most issues with? Collection, disbursement, both, none of the above. And this is our second of 4 that we'll have today. And just a reminder, you have to answer 3 to get the CPE credit. I'm going to give about another 20, 30 seconds or so to get your answers in. If you have technical difficulties with this all, just a quick reminder to go into the Q&A box on the bottom of your screen, and right in there we will get back to you with some help. Okay, let's take a look at the results. All right, Corey, what are your take with these results?
Yeah, I'm not surprised that collections is out there in the front. It's typically the hardest to get all your banks to communicate with each other. But disbursements is up there a little higher than I would have expected. But overall, I see it as sort of a standard indicator as to some of the pain points that companies have with both collections and disbursements.
Awesome. All right, well, that wraps up our second polling question. Corey, we will kick it back over to you.
Thank you, Dorothy. Thank you, everyone, for participating in the poll. And just to recap, we discussed objectives of cash management system, maintaining cash balance, preparing cash balances, objectives of cash management in itself, and disbursement and concentration decisions. So next, we're going to cover cash management strategies. In cash management strategies, there's 4 models that are used. There are a couple that are most common. The first model is the BOMO model, 2-transaction strategy with a 3-transaction strategy. Second one is the Vernick model. Third is Miller-Orr model, and fourth is Stone model. The BOMO model and the Miller-Orr model are the most common, specifically BOMO model around cash management and Miller-Orr around treasury. Although these models, they are used to create an optimal approach for investment of your cash assets, they are very useful in providing the strategy or the goals or the metrics that you're going to need for a given time pattern of the cash flows based on the trade-off of investment income related to transaction costs. These models are great. They definitely can put the numbers, hard numbers on your spreadsheet, but they provide, they provide pretty good useful insights as well, but the limitations have to be stressed. And like all optimization models, your domain is constrained by the assumption with which in your economic environment is for the current state. So if you're looking at perspective of what model you use or what cash application you currently use, you're going to be able to figure out why your forecasts or maybe why your positioning is so off. These are great tools that you can pick up and implement into your process. So next, I'd like to talk about managing cash flows. Part of cash management strategy is obviously managing your cash flows. From the task of managing, you're going to have acceleration of collection. You want to establishment of collection centers. You need lockbox systems. You want to slow your disbursements. You want to avoid early payments. You want to centralize your disbursements. And you want to reduce your floats through your payments of checks or using checks. So next, we're going to talk about the advantages of setting up an efficient collection system. So what are the advantages? What are the advantages of concentrating your cash? The collection process can result in a larger pool of funds that are temporarily interest-earning investments, and it becomes more economical. With all the cash in a central location, the control of the cash is simplified. It allows you to make better decisions. And as a result, it also simplifies your short-term financing and investment decisions. So as a whole, having a collection, I won't say foolproof, but having a best practice collection system and disbursement system is going to help you with the bringing all of your cash into your main concentration account for investing. So next is striving for that optimal cash balance, and there's several factors to really take into consideration. So to maintain your optimum cash balance and to keep optimum cash balance requirements at a minimal level of collection and late disbursement, you're going to have the synchronization of cash flows, cash shortages, excess cash balances, compensating balances, uncertainty, firms' capability to borrow and emergence, efficiency of management. So next we talk about the collection system from that perspective. I'm optimizing and reducing your floats costs from speedy availability of banking system, reducing operating costs in your collection system, reducing operating costs in your managing system, reducing those mail floats, and reducing your processing floats and reducing those availability floats. So next, I'd like to talk. Next, I would want to discuss the collection system as to the design of what that collection system should look like. So you want to have a number of collection points determined. Location is very critical to your collection points based on regions to different countries or within the different banking structures. Internal and external operations of collection points. How do we move the money through the banks, but how do we internally move the money as well? Assignment of individual payers in the collection points, as far as capture the movement and information of those payments. In order to identify what it takes to build a collection system, you have to have the ability to have a foundation in your disbursement setup or disbursement process. So the main disbursement, obviously, controlled disbursement comes from the function from the bank or corporate clients that have see their expenditures on the disbursement on a daily basis, which is controlled for a period of time. Typically, you have no cash just kept in the account other than to cover the expected bills. You might have multiple sweeps, company-initiated requests, amounts sent to cover expected outstanding payments. Threshold balance can be maintained at times when the amount is expected. The expected amount of bills or payables is less than the estimate at which point, or over the estimate. So there's some critical factors at the setting up your disbursement system to take into consideration. So what are some of the tools, other tools that are available? This is the zero balance account. Zero balance account is pretty much exactly what you currently probably use, but what it sounds like. The balance is zero, maintain the fund when the funds are needed. There's a ZVA sweep, an exact amount is required, automatically transferred from a central or master account. Specifically, I find this most common out in the industry. The no cash should be kept in that account as a morning sweep or evening sweep. Bank-initiated requests and amount requested to cover those outstanding payments. And so now that we have a collection, disbursement, and we're concentrating those funds, the last tool is marketable securities. Marketable securities, in short, or they can be liquidated into cash quickly. They can be bought and sold on public stock or public bond exchange. These securities tend to mature a year or less. It can be either debt or equity. The other piece is that the investment in the physical infrastructure, product research, development, market initiatives, and pursuit of strategic objectives. When there is an abundant, I say abundant as surplus cash on hand to be able to invest adequately, but be able to still release and cover your bills the next day. And the responsibility to put these surplus assets to work and to bring the greatest possible returns. The alternative would be to let the cash, your surplus cash, sit idle overnight, where it could be earning. Now that we've defined the cash management processes and tools, let's talk a little bit more about cash management best practices. And we have poll number 3.
All right, this is our third polling question of the day. Do you have plans to improve your cash management system? Yes, no, where do I start? There will be one more polling question after this. Just a reminder, you have to answer 3 out of 4. We'll give it about another 20 to 30 seconds here before we take a look at the results. Okay, let's go ahead and look at what our results are. Corey, what are your thoughts around the results?
Yeah, I would say that over half of us are trying to improve our cash management process. It's pretty common. I am surprised. I would definitely love to meet the 36%, 36.7%, and whether or not they, to improve, whether it's perfect or if there's just no initiative to do it at this point in time. But overall, these numbers look really great.
Awesome. So that wraps up our third polling question. There will be one more today. All right, back to you, Corey.
Thank you, Dorothy. Thanks, everyone, for participating in the poll. Next, I'd like to talk about the cash management best practices. Typically, we all talk about best practices, but really want to bring it home with what do we need to improve our cash management systems and processes. So first, I started out with making it visible. This is kind of the number one thing I run into with clients, is that seeing the data, or at least getting the data into their hands to be able to make those analytical decisions instead of reactive decisions. So you're going to need cash flow reporting, and cash flow management should have heavy reporting. This is not only going to support your cash position and forecast, but also support reconciliation and accounting processes downstream, help shorten those month-end close processes. So to truly foster a cash management culture, you're going to need to track cash flows actively. Forecasting is a critical step in that management. Ultimately, it's going to improve your profitability to be able to reduce that variance between what you forecasted and what you actually positioned for, is going to then really dial or carve out that excess cash that would be available to you. Second piece is that involves looking at both income and cash flow statements and linking your cash flow forecast to those key working capital metrics from the balance sheet, such as days inventory on hand or days sales outstanding. or even days payable outstanding. And also you want to be sure to include your capital expenditures, debt repayments, other operating cash flows that management is aware of, and a full spectrum of your cash requirements. To enhance these cash forecast accuracy, consider automating the process instead of relying on spreadsheets, as we have all heard. Why? Is because it's beneficial to have that real-time, accurate data at your, I would say, at a click of a button. And it's also beneficial to have that forecast accuracy, because then you can accurately review those variances for that position compared to that forecast, and use the process to refine and improve the accuracy of the forecast. If you look at the metrics that you're measuring and how you're predicting your forecast, this is going to help bring that variance down. You also want to integrate your cash flow forecasting with your P&L statement, your balance sheets, to ensure that you can track performance against all of the different indicators. So when times are tight, cash management can be even more important. Buying time for the key stakeholders, reducing likelihood of covenant breaches within your loans or bonds, minimizing the need for additional financing because you already have sort of an in-house bank up and running, or maybe you already have an in-house bank that you're using. Be ready to move your weekly cash flow forecasting and reporting on a click of a button, like I say, or running of a report, and improving visibility and reliability of the information. And you want to consider establishing sort of a cash committee to oversee the process to drive change throughout the organization in order to put in some of these new policies or procedures that you're looking for to improve your cash management process. And really the importance of this, and I like to use this, is I had a client when I moved them from Excel to a TMS system, and when we started, we had 17 daily cash positions that we created. And as we worked through the years and bringing more data online, we reduced those daily cash position worksheets down to 4. And so I guess the moral of the story is that, it's not perfect the first time around, but through some analytical research and through metrics, you can definitely drive down the efficiency levels of your processes for cash managing. So next is optimizing your financial functions. Every business has both short and long-term cash flow obligations. Your short-term requirements encompass your day-to-day operational expenses. Your longer-term obligations typically refer to your capital project investments and term debt maturities. To become proficient at the cash flow management, you must match your various funding sources. It's very important to your capital flows. This will ensure that otherwise profitable businesses have access to the cash. So if your organization can have this process with the various sources included, you're going to have access to the cash that you would need in order to meet those ongoing obligations. So next, let's talk about the elements to implement or shorten your cash conversion cycle. So I put up here using technology to shorten your cash conversion cycle. It is very important to have your bank statements electronically centralized in a location, whether it's in a TMS system or ERP system. It's pretty vital to doing some of the activities that we discussed earlier. Creating a centralized payment hub, very important as to limiting costs and exposure to the banks, as to sending payments to whatever sources are needed for payment, linking all of those sources of payments, receipts electronically. This will allow for a more accurate reconciliation process. Delivering invoices electronically rather than via email. Obviously, with they're scanned in, this provides that content that you're going to need in order to do proper accounting allocations and reconciliation. Implementing a vendor portal can give you vendors electronic access to invoices, electronic payments, reducing time, and then also resolve disputes and being paid. And you also want to create a set of reporting to analyze your cash flows proactively. And a lot of times when I work with clients, the number one thing we do is take all of your reports and start to put them into buckets as to must-haves and needs improvements. And in a sense, it becomes just as vital to your organization as the application that you're currently paying for. And last is our last polling question of the day. Dorothy, take it over.
All right, this is our fourth and final polling question. Do you currently have a strategy in place to implement new cash management technology? Yes, still planning, no strategy. Give everyone about 30 to 40 more seconds to answer this one. If you run into any technology issues, just let us know in the Q&A. This is going to be the last polling question. So if you've only answered 2 so far, make sure you answer this one. Okay, let's go ahead and take a look at the results. All right, Corey, what are your thoughts around the results?
Yeah, as far as the no strategy, I'm not sure if it just already is just kind of a way of going at it from how you're doing business today, but definitely would think about how you would implement some sort of foundational strategy going forward. It would definitely help with improving processes and efficiencies within your daily cash management activities.
Awesome, thank you. All right, everyone. So if you have met all 3 of the CPE requirements, you should be able to download your certificate in the Cpe Certification Requirements box. Let us know in the Q&A box if you're facing any issues or require any troubleshooting, and we will respond as quickly as possible to get that figured out for you. All right, and everyone, thank you so much for attending the webinar today. Shortly after the event concludes, you will receive an email with a link to the PDF copy of the presentation, so you're able to download these slides and keep them and refer back to them. I'd like to thank you to our presenter, Corey, for leading this discussion. If you have any questions or if you want to set up a one-on-one call with Corey or another one of our experts, please feel free to email us at treasury@morganfranklin.com. With that said, my name is Dorothy Hinders, and thank you so much for joining, and I hope you have a great rest of your Thursday, and we hope to see you next time.
Thank you, everyone.